Hello, everybody. Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Trying to keep up with that frenzy of retail trading activity? Well, so are we. And we have two people who hopefully will be able to give you some answers today. Jamie Wise is the founder of the newly launched VanEck Vector Social Sentiment ETF. That's Buzz, B-U-Z-Z, and Art Amador, the brains behind the AI-powered equity ETF, the symbol there, AIEQ. He uses artificial intelligence to pick stocks with the highest capital appreciation. Todd Rosenbluth, my old buddy from CFRA, joins us as well with his overall perspective. Jamie, we had you on a month ago. I said we'd have you back. You had a big launch there with Dave Portnoy as your partner. You've got, I think, nearly $500 million, bringing me up to date on that, in assets under management. But you're still very heavily invested towards a lot of the old school tech stocks. I see AMD in there, Apple and Amazon. I see some new stuff there. I see Square. I see Tesla, Virgin Galactic thrown in. What are you hearing these days? What have you learned running this thing for a month using social media as a method of buying stocks? Tell us what you've learned.
You bet. Nice to be back. And well, it's been a month since the ETF has been live. Of course, the index behind the fund has been around for almost 5 years now. So we've really learned a lot throughout that time. And while we, as you mentioned, experienced a very successful, launch of the index in the last month, what we've really learned over the last 5 years is that there's so much more to the insights that we can observe from, the millions of people talking about stocks and the kinds of stocks they're talking about. And it's not all high-flying growth stocks or tech stocks. There's a lot of different lenses that people can look at security valuation. Of course, that can be growth is one of those lenses, but naturally values another lens, and a lot of reasons why people are talking about stocks, especially of late. And maybe what we've learned more recently is we've seen that rotation continue a little bit within the Buzz Index, where we've welcomed, as of the last monthly rebalance, stocks like Costco and Target, Norwegian Cruise Lines, Marathon Oil. So some, more value-oriented or traditional old economy stocks. I think, the collective conviction and where people are positive, they're seeing some of these trends reemerge. They're seeing, the end of COVID potentially in sight, and they're starting to position their portfolios, accordingly. And certainly some of those old stocks drove performance this year to date, right? We look at the best performing names in the Buzz Index, and you'll see a name like Ford or American Airlines really contributing to the continued outperformance of Buzz over, traditional long-only strategies.
Yeah. And Art, it's interesting what Jamie has to say about that, value tilt that we've been seeing. He reflects that. He can rebalance on a monthly basis. AIEQ has also been around a pretty long time. You still have some pretty heavy bets on tech, though. Apple, Applied Materials, Alphabet, Intel, I see amongst your biggest holdings here. Can you tell us how AIEQ works? How do you pick stocks? And explain why you've still got a fairly heavy tech tilt towards that. And what's the model telling you at this point?
Yeah, so AIEQ is powered by IBM Watson and EquBot AI. And the idea is to identify U.S. companies with the highest potential for price appreciation. And Bob, we do this every day by combining millions of news articles, social media posts, and industry reports, macro and market data, financial statements on more than 6,000 U.S. companies. And then we select about 150 companies that, in aggregate, have the highest opportunity for price appreciation. And one of the things that we're currently seeing within the models is we're observing positive signals for technology hardware demand. And this is being reflected in demand for chips. So semiconductors is actually the largest overweight that we're seeing. In the top 10, you'll find names like Applied Materials, Intel, AMD. And then kind of interesting, although we are overweight technology names, we've actually been seeing kind of a scaling back of some of the technology software names like CrowdStrike, Zoom, DocuSign, Zscaler, where these used to be, top holdings. They've been scaled back quite a bit. We still own them. They're still important stocks, but we're seeing kind of a reallocation to some of the reopening benefactors, companies like Uber, Bank of America, Cimarex Energy, and Six Flags, as well as some REITs. Yeah.
Now, Art, demystify this a little. You say we see positive signals for technology. What are the positive signals? This all sounds, a little mysterious here. robo-advisor is telling you, I see positive signals. Well, what is the positive signals? Can you tell us? Just explain it a little more.
Yeah, so I think the best way to break it down is that so each company has 4 deep learning models running on it. And so the first model is looking at things like financials, right? Think fundamentals, EPS, revenue, EBITDA. The second is news and information, looking at things like sentiment, pricing, and volume data. Third is management models, looking at things like ESG, innovation spend. And the fourth is macro models, think GDP, unemployment, and housing starts. And one of the important things is it's never just one signal, Bob. And so it's hard to say, hey, it's this one piece of data, right? AI is all about recognizing patterns. And so it's patterns right across the structured data and the unstructured data. It's combining things like sentiment with financials, with macro that really makes AIEQ's predictability so powerful.
Yeah. Todd, you've been watching this for a long time, attempts to pick stocks using not just fundamentals, but all sorts of other metrics and then combining them. We now have the AI to do this. Just the ability to crunch these numbers is rather remarkable to me. We've never had this ability up until fairly recently. What do you make of all these attempts to use ETFs to capture whatever trader sentiment or broad ranges of data points? What's your take on all of this?
So we've had, as you mentioned, Bob, we've had multi-factor strategies that are combining momentum and value and profitability characteristics. But what we haven't had up until these 2 products is something that is rebalancing either on a monthly basis in the case of Buzz or the potential to make changes on a daily basis in the case of AIEQ. For example, MTUM, which is the iShares Momentum ETF, rebalances every 6 months. So it still is heavily laden towards technology and consumer discretionary and has less exposure to industrials, has almost no financials, has 0 energy exposure. Those latter sectors have been leading the market to start 2021, and they're just not catching up within the ETF. It will get there in the coming months, but it's something that's happening and rebalancing faster, or the potential to do so, is going to respond to market sentiment shifts in a more rapid manner.
Yeah, that's a good point. Jamie, last time you were on, I believe we had the fellow who was launching the FOMO ETF, the fear of missing out ETF, not with us yet, but it's been in a filing. That one rebalances once a week. You rebalances once a month. It seems like this rush toward rebalancing is accelerating toward an almost daily rebalancing. What are the pros and cons of rebalancing on a more or less regular basis?
Yeah, and the approach at Buzz is very different than FOMO. It's not about identifying the current meme stock and quickly getting exposure to it. What we're doing with Buzz and why we think it's important to rebalance monthly is we're capturing these sentiment trends. And Todd had a great point around the factor exposures that exist in the market. Our view at Buzz over the last 5 years has always been that, sentiment has been a factor that's existed for hundreds of years in price discovery. The difficulty, as you mentioned, Bob, was that it couldn't be measured until we had the tools to measure it and the platforms of millions of people talking about individual stocks, where we could now measure the difference between the sentiment on Boeing and Disney and GE and Netflix and Microsoft and all the other stocks we're familiar with. And to the extent that we can do that, essentially the return stream of Buzz is the sentiment factor that people have been after for a long time, that we can now measure and support with data. So it's not about proxies to try and measure sentiment or an expert's opinion. We can support it with data. We can support it with a 5-year live track record. And we can now introduce that sentiment factor into other factor-based approaches. So to the extent that sentiment is this dynamic factor that can have exposure to energy and financials as market environments shift, you can achieve that exposure by rebalancing monthly to that sentiment factor.
Yeah. Art, I'm wondering where all this is going down the road. I grew up with science fiction, and I grew up with, robots and artificial intelligence in the 50s and 60s, and we're finally here to a certain extent. But the way I see this, eventually my AI trading program, which will be a subset of my personal digital assistant, will eventually launch, and it'll be trading against your AI, and it will be pretty darn good because it'll have access to very, very wide swaths of information very, very quickly. So maybe, maybe I'm not Renaissance Technologies yet, but I'm pretty darn close. And I don't think that's actually very far off. Can you give us you're an AI guy. Am what I'm saying making any sense? Is it quite likely in the future? We already have viewers messaging me saying, Bob, I really want to figure out. Tell me more about these ETFs that buy stuff that's really moving fast. I don't know what's going on, but I want to be on this Reddit story, even though I don't know where they are. Figure out how to do that and how to capture it. So can you envision a day when my AI trading program interacts with your AI trading program, and they're all pretty darn good, and the ability to outperform one against the other gets smaller and smaller eventually?
That's so far in the future, Bob, and here's why, right? So Todd kind of touched on this briefly. So when I think about the current algos in the market, right, a lot of these are these legacy factor models, right? And I want you to think about models and data, right? And these legacy factor models, right, they're all very similar, right? They're all kind of based on that Chicago school of thought. And the data that they're looking at, right, is very limited, right? This is kind of the structured historical data. And I say it's limited, right, because think about what our partner at IBM says, right? 90% of the data in existence today, right, has been created in the past 2 years, right? We're going to be saying that every 2 years, right, going forward. So AI's ability, right, to capture this growing amount of data, right, only scratching the surface, right? And the other thing is, when I think about AI models, right, the diversity within the AI models, right, is incredible. So what happens is you get crowded trades with legacy factor models, and with AI models, diverse set, growing data, there's going to be alpha for these funds for the foreseeable future. There's going to be many different models. So this is just the first inning, Bob.
It sounds to me, Todd, like what happened a number of years ago when do you remember late 90s when all of a sudden we had very efficient matching engines that suddenly started coming up that were trading programs, and I'm thinking of programs like Island that existed, programs that like the NYSE bought, the really fast programs they bought, and these programs. Many of them initially just were employed by people who were matching the S&P futures in the trading pits against the S&P futures that were trading electronically. And Todd, remember there was a period where you would think it's the same instrument, they're fungible, and yet there was a very noticeable gap between the electronic trade and the pit trade, and it made a number of firms very, very wealthy for a long time. And that kind of, I guess you would call it statistical arbitrage or whatever, eventually became much more difficult to do. You can still do that, Todd, but it's a lot harder. And that's my point here, I guess I'm trying to make with everybody, that yes, you can still do it. I don't know how much longer it is in the future where there's enormous amounts of money to be made, essentially scalping different people's opinions on a day-to-day basis.
Well, I think what we also need to bring into this is that most ETFs are tracking more traditional indices that don't rebalance that regularly. The S&P 500, that's a market cap weighted, price momentum driven approach to it. And then we've got this smaller subset but growing actively managed ETF universe that's using qualitative factors. So the ARC funds that Cathie Wood runs would be a perfect example of it. Whereas what AIEQ is doing is actively managed, but using a much smarter computer models than I would be if I was picking stocks, or a portfolio manager might be picking stocks. Yeah. But there's less qualitative factors that are, you're less likely to stick with a winner longer, with a longer time horizon, the way that, that Cathie Wood and team are doing.